Great. Well, I hope everyone had a nice day and a nice evening yesterday. It's good to see so many of you back here this morning looking fresh, or maybe semi-fresh. We can agree on that terminology. So today is a different day to yesterday. As you know, yesterday was all about investing and the Business Owner Fund. We saw Wix, which was one of our investments, and then did the Q&A. Today is a completely different day where I'm not the center of attention, but you guys are. And the day is really dedicated to what I call emerging managers. So people who either have very recently started a fund, or more importantly, those of them who are dreaming of starting a fund. The way this day came about was when a lot of people read my letters, and increasingly people would reach out to me and ask me, how did I get started, and what should they do? And it was sort of becoming a little bit too much to speak to all of these people individually. So Michael Birkel, a good friend of mine, once said, well, why not just get them all together in one room, and then they can all see you at one time, and more importantly, they can also see each other. And I thought that was a great idea, and so that's the reason this day came about. Sometimes people ask me as well what my motivation is. I feel very strongly that I've benefited very much from my network. Until 2 years ago, RV Capital was a one-man firm, which meant that all of the exchanges I had were with people in my network, and since a year and a half we're a two-man firm with Andreas. But both Andreas and I really enjoy and value the exchange with other people, and thank all of you, or many of you, for that. But of course, if you want to have a great network, you have to make sure the network thrives, and so that's a little bit our motivation as well, to help many of you get started. So that's enough about today and the event. We're going to have, maybe just quickly on the schedule, we're going to have 3 panels this morning. So from 9 until 9:40, then there'll be a 20-minute coffee break, and then the next one will be from 10 until 10:40 with another 20-minute coffee break, and then the last one from 11 to 11:40, from 11:20 to 11:40 until 12 o'clock, and then 12 o'clock is when we finish. I've got a feeling I might have garbled that a little bit, but hopefully you know what I mean, and if not, we'll at the end of the panels say when the next one starts. So there's going to be 3 panels. The first one, which I'll introduce very soon, is the Emerging Manager panel, made up of 3 youngish emerging managers who recently started a fund, who I've valued having an exchange of ideas with, and where they're going to talk a little bit about their journey and pass on some advice to younger or investment managers who are earlier in their stage, which is maybe a little bit more relevant than mine. Any advice I could give would have been from sort of 15, 20 years ago, whereas they've lived through this much more recently. Then the second panel, which will be at 10 o'clock, for the first time, that's going to be a panel which isn't moderated by me. It's going to be moderated by my eldest daughter, Amelie. And that's about women in investing. All of you will have noticed that investing events, including this one, tend to attract a disproportionately high number of men. And so I'm curious about what they make of that, and what sort of conclusions and lessons they can share with us. And then the final panel will be made up of 3 capital allocators, so allocators who allocate money to young managers or to investment managers in general, and it's an opportunity for you guys to ask them, what type of qualities do you look for in a manager, and what are the pitfalls to avoid, and so on and so forth. So, so much for today's structure, and let's get straight into the panel. We've got 3 people here, and maybe I'll ask each of you just to briefly introduce yourselves. I'll then ask probably a handful of questions, and then the mics will go around so that all of you can ask your questions. So Tim, why don't we start with you? Maybe you could tell us a little bit about who you are, where you're from, and what your fund is.
Hey, thanks for having me, Rob. So my name's Tim Liu, and I'm the founder of Meditation Capital, which I launched in May 2022.
Congratulations. Round of applause for that, huh?
So I was born in China, and I know Rob really likes Chinese, so he specifically asked about that point. So I was born in China, and I moved to the US when I was 4, and so grew up in the US, and then went to college, and then spent 10 years in the hedge fund industry. And for a long time, I wanted to launch a fund, but didn't have like a clearly differentiated strategy. And then one day when I was looking through all the investments I tended to like, a clear pattern emerged, and then I decided to launch this fund. Should I talk a bit about that?
No, I'll come back to that later. Maybe just how we got to meet. A common friend of both of ours, Stephen Shen,
Yes.
put together a group chat, I think really at the start of the Corona crisis, and I think you and me and many of us in that chat became good friends really virtually just through participating in that chat.
Absolutely. Our friend Stephen was an absolute savant at cutting the COVID numbers every which way in the US and China and so on. And so that chat was instrumental in helping our investing during that time. And through that I met Rob, and then we finally met up in person, I think at Berkshire in 2022. And then since then I've been meeting Rob in all these unexpected places in New York, at the Basic Fit Investor Day in Amsterdam, where he brought his son, and now here. And so it's great to see you so many times, yeah.
Well, it's great to have you here, Tim. Fred, same question to you.
Yeah, does it work?
Yep.
Well, thanks for having me, Rob. So I'm Fred. I'm 40, married with 3 young kids. I guess I'm the youngish part of your introduction.
Anything below 50 is young from my perspective.
I was actually born and raised in this glorious country, so I'm always very happy to come back to my home country. I mean, Oxylus, which is the name of my fund, has been a very long-term project in the making. Something because I got bit by the bug of investing in my teens. Started to invest when I was 15, which is the first legal age in the canton of Geneva, where I was born and raised. Where I asked my waiver of my parents a waiver to be able to invest in the stock market, and that made me more focused on achieving the right steps along the way to build my path to set up Oxylus. So I've always worked in London, so I started my career in London, and I've been in London for almost 2 decades now. Starting in investment banking, then in private equity, then in the hedge fund world at Soros, and then in an investment partnership called Dynamo in London before launching in Q1 2021. So that's pretty much.
Congratulations to you as well.
Thank you.
So thank you for being here. It's a pleasure to be sitting in these seats where so many great investors have been sitting. My name is Joan Esteve Manasanch. I am from Barcelona, and I'm the manager of a concentrated hedge fund we just launched last year, which was a restructuring of a UCITS fund I had launched in 2017. I'm currently the investment officer of a family-owned asset management company from Barcelona, which is owned by the Torrella family, who is one of the investors supporting our project. And I'm an independent asset manager since 2015, where I started 2 years managing private accounts. And then in 2017, we launched a UCITS fund, an own UCITS fund, in which legally I was the the fund advisor, because that structure was cheaper. And the asset management company who was doing all the administration was like the one that was doing all the management of the administration, basically. And this UCITS fund was launched as a UCITS structure because the initial investors, which is something very important when you start, that had the right mindset of long-term investment and permanent capital, they required the UCITS structure because they were investing through a UCITS funds, so they required that UCITS structure. After 4 years in which the management and the profitability of the fund was nice, we transferred, or we started the transfer of with the transition of the UCITS fund to a hedge fund, right? Which in Spain the name is Fondo de Inversión Libre, and to have the freedom to concentrate in the best ideas, because during the 4 years and a half we have been managed the UCITS fund, we were doing a parallel management, virtual parallel management of what was the real drag that was having on our investment way or investment process, having the obligation to be invested in more than 16 or 20.
I think it's a motivation for a lot of managers is to find a sort of a concentrated structure early on.
Because...
So I'll maybe ask you just to pause there, because that was going to be my next question anyway to all of you. Maybe starting with Fred this time, which is, you know, there's this incredible chicken and an egg dilemma when you get started. You know, typically people will say to you, to start a fund, you need at least $5 or $10 million of capital, and of course, unless you have a rich uncle or aunt or something, most people wouldn't have that kind of money. So it's very difficult to get a fund started. So I'd be curious to ask each of you how you kind of solve that sort of problem.
Luck, I would say. No, but I mean, there's no right or wrong answer. You're absolutely right. I mean, I'll just talk for myself, but that's not an advice.
We're here to hear your story, so.
Yeah. So in my case, the reason I say luck is, you know, if you think of essentially the 3 hats that one needs to wear if you want to launch your own fund, everybody knows the first one, which is the CIO hat, right? So the CIO, PM, analyst, whatever you want to call it. Then there's a second one, which is the CEO hat. I mean, you're running essentially a small business. And then there's a third one, which is essentially, I mean, it depends for some people. Some people would hire someone to do it. I do it myself, which is to manage the relationship with your partners, right? So you need to think, and it's equally important to think about these 3 hats, right? And when I wanted to start, essentially, you know, I went around to ask my friends that did it successfully, but also unsuccessfully, because, I mean, what you notice, like in all walks in life, is that people that are successful for different reasons, but people that fail, sadly fail for the same reason. So like, I tend to be a half-empty type of guy. So that's what I focused on. And what I noticed is that usually people would tend to fail not because of the first hat, but because of the second and the third hat. Because most people that would tend to go down that route would tend to be focused on the first hat, but, you know, and they do not necessarily enjoy the second and the third one. So when you think about building that path, you need to think about these 3 hats equally importantly and to really build your path along these 3 axes. Which brings me to the chicken and the egg problem, which is down to the third hat, which, by my own admission, which is why I say it's luck, is the one that I did not necessarily spend enough time on. The reason I was lucky is because I had a friend, you know, who very successfully launched, and who was at Dynamo with me, and who very successfully launched a fund a few years before me. And I did a few reference calls for him with very prestigious institutions, so mostly US endowments, single family office, and foundations. And one of them, actually, or a few of them, actually, were not able to, he had a good problem, he had too much money being thrown at him, so there were a few people that, you know, left empty-handed. And so my first port of call was very simplistically, you know, one of the guys that I did the reference calls with, and they ended up being our anchor investor. And so that's how we sold the chicken and the egg, which is why I say, you know, it's no advice or whatever. The advice is more like, you should think about it much more than I did, and not just be lucky as I was.
I'm curious about the next 2 answers, but I think the element of luck is always a really important part, but part of luck is also putting yourself in the right place, so clearly you did that.
Yes, so, I mean, here, I think it's very important in the sense that when you try to do pattern recognition on or at least the investment partnership and, you know, the manager that I admired in London or globally, right? And I will not name names, but some of them very, very large. You would notice, you know, some pattern is that there is, I don't know how you say it in English, but kind of affiliation in the sense that usually they would be people that have, you know, been surrounded, so being taught by the right teachers, being surrounded by the right mentors. And that's something that is within your control. So, I mean,
That's a great point, yeah.
So, and I think it's very important, you know, I mean, in my case, certainly you know, my teachers at First Reserve, Mark, you know, Igor, at Soros, obviously Bruno, at Dynamo, and then all of the others, mentors have been really, really helpful. So that's, you're right, that's within your control, and that's something that is.
Let me ask you to pause there, and I'll pass over the mic to Joan, and maybe Joan, you can talk about your hedge fund or your current structure and how that kind of came about, and or whichever you think was the most important sort of relationship and that sort of pathway you described in your last answer.
Well, it's fundamental to have the support, if you don't have a wealth on your own, to launch these structures, right? So it was a key part in my case that one of the investors of my initial UCITS fund had a family-owned asset management company who wanted to support the transition to a hedge fund, to a more, let's say, unconstrained, flexible, and for someone who is investing, looking at the fundamentals of the company, can just focus on the best investments with less risk, let's say. More control on what you are investing at. And I think that was fundamental to having support of some family offices, which had already been invested with you for a while, for a long time. And the contacts of these people came from different places. One is a contact from the London Business School, which I studied at. And another is a very successful entrepreneur, let's say, from my region, which I met through my sister. And the other is the Torreya family, which were investing in my initial fund, and they have this asset management company. So these are three of the examples of how you can find investors who have the same mindset as you.
Perfect. And Tim, the same question to you.
About the chicken and egg, right? Yeah. Rob, I found your letter to independent fund managers absolutely crucial for me to think about this problem. So I think 10 years ago, Rob wrote a letter to aspiring investment managers, and he had like 10 bullet points of advice. And I think I read it like 5 or 10 times since then. I think I read it when it came out, and then I'm going back to it over and over again. And it was enormously encouraging because Rob laid out in clear terms the reality that emerging managers may face. So one of the points was like, don't market because no one will invest. And I saw that, and it made a lot of sense and reconciled my experience. Like when you're a new manager without much track record, without a team, with very small AUM, the only people investing in you are going to be close friends and family. And so you should focus on the performance of the fund more than anything. Rob, you had this amazing line I think about a lot, which is there's no shortage of demand for managers with a credible strategy who can turn 50 cents into dollars. And if you can do that, then the money will come, the AUM will come later. And so looking at that line is like enormously encouraging because like you're small now, but just focus on the returns. So for me, the chicken and egg problem is not solved. There's no chicken yet, but Rob's path lays out a clear way to get there. I think Rob's example and also our friend Steven's example, just like starting from very small amounts and then scaling from there, I think it's a dramatic contrast to the traditional model where you raise 100, 200 million, you have a hot team, you have a couple years to have good returns or you shut down. And that's the complete opposite. And so knowing about that, like seeing someone doing that was very valuable. So yeah, thank you, Rob, for writing that. Thank you, and thank you for the mentorship.
Thank you, Tim, for your generous comments there. I really appreciate it. So I'm going to ask one last question, and I think I'll hand over the mics will start going around so you can ask your questions. If each of you could just briefly, in maybe 2 or 3 sentences, describe the legal structure you invest through. And the point of that is not to get into a legal discussion now. I think we'll lose half the audience if we do that. But just so people who come from the same geography and are thinking about structures and stuff can then reach out to you guys maybe offline to kind of discuss that. So Tim, why don't you go first on this one?
Again, this is taking inspiration from like the simplicity.
Yeah.
And so I'm in the US. I set it up as a very simple fund. it's a Delaware LLC, so a US-based LLC. And later on, you can always attach a Cayman Islands master feeder structure off to it, for which many institutional investors and foreign investors will want. But initially, it's just like a very simple structure. And then happy to chat with anyone about the vendors I use. I think I found that vendors often cost significantly less than I expected before looking into it. And you can always find cheap but pretty good vendors. And so the list of like administrators, prime brokers, are happy to talk to anyone about.
Yeah, and just very briefly as well, just in terms of cost, ballpark, are we talking thousands of dollars to set something like this up, tens of thousands, even hundreds of thousands? What, just very approximate ballpark?
So legal fees to set something up from a reputable law firm, I think, will be $40K, like a one-time fee, which you can charge to the fund. And the law allows you to amortize that over 60 months. And so in theory, it's a charge to the fund. And then ongoing expenses, administrator, for example, was $6,000 a year, way cheaper than I expected. Prime broker is quote unquote free, but you're paying through trading. Some of the biggest expenses were like audit and tax. Those really run up to the, call it like 20, 30K range. But if you add it all up, not including the initial upfront cost of the 40K, I think you can do like 50, 60K of like annual expense.
That's awesome. Thank you so much. Yeah, Fred, maybe the same question to you.
Thanks. Yeah. So for us, we have Cayman Master Fund with an offshore feeder and investment management agreement with a management company based in London, authorized and regulated by the FCA. So similar to
similar cost and on running costs.
It's a bit more expensive.
Yeah.
Obviously, the reason we set it up that way is mainly for the type of partners that we cater to. We were lucky to have, from day one, institutional, very prestigious, US-based investors, and that's usually the kind of structure that they expect, and that's still, and that matches very well with the type of mandate that we have. In terms of cost, I mean, the cost to set up the legal structure. By the way, never believe, and sorry, I know you picked on the lawyers yesterday, but never believe what the bills of the lawyers would say. Always put a cap. You will always hit the cap, no matter what you say. But the cost of the legal structure. So for the Cayman, Master Fund plus the offshore feeder, you're talking about $100 again, charged to the fee, amortized over 60 months. If you wanted to add a Delaware feeder, which is for taxable investors, so US taxable investors, that would be another 15, so 15K, which you don't need at the beginning, and you can still have taxable investor investing in the offshore structure and having a PFIC, but I will not get into the specifics here. And then setting up the management company in London legally, I mean, you're talking about, I'd say 10 to 15 again. So that's broadly the cost. I will ask you about your fund admin because mine is slightly more expensive than that.
That's good if we can get a better deal from service providers out of this meeting then.
And my hedge fund is incorporated in Spain, which is a cheaper jurisdiction than other places, and also had some fiscal advantages for Spanish investors. So basically, it's unconstrained long-only hedge fund, which the legal term is Fondo de Inversión Libre. And it's not very easy to get the approval, so you need to have some people who has already had experience on this kind of hedge funds for the regulator to approve it, for example. So you need to
cost roughly set up, if you don't mind saying.
The cost setup should be something between 15,000 and 20,000.
Okay, makes sense. Yeah. And I'm going to ask actually one more question before I let the mics go around. But I see the time is racing, so try and be as quick as you can. Just briefly describe your strategies, the way you invest. Joan, do you want to go first on that one? Or?
Can you repeat the question, sorry?
if you could just describe your investment strategy in 2 or 3 sentences, yeah.
Okay. Basically, I try to specialize in finding what I call the successful business models, and then to see where, in which industries, in which sectors, and which companies to apply those successful business models. You know, these successful business models are business models that are designed by the managers. So in this investment philosophy, looking at the management actions is very important, management mindset, that allow you to have long-term returns above average and in a structural growth sector.
Perfect. Just in the interest of time, I'll stop you there, and then we're going to go for the questions. So, Fred?
Yeah, so Oxylus is an investment partnership focused solely on Europe with a very strong bias to small and mid caps. We tend to apply a quote-unquote, sorry about that, private equity approach to public markets. So that's research intensive, long-term, concentrated with a constructive approach with management, with a very specific focus on paradigm shifts within the industries or companies that we tend to invest in, as well as temporary woes, with a strong focus on structural market inefficiencies and intangible features of the companies that we invest in within very specific clusters, and again, just in Europe.
Perfect. While Tim has a chance to formulate his response, if Tommy and Olivia are here, oh, you have the microphones? Great, so we're all set for when the Q&A starts. Okay.
And my fund is a global long-only fund. So the strategy is to focus on companies with amazing products that customers love, that add a lot of value to customers, that have really high NPS. Kind of like some of your investments, like Ryman Healthcare and things like that. I really like that type of investment. It comes from studying Bezos and the obsession with the customer, and also from studying these Chinese companies that, if just from surveying, there's no large Chinese company that has a bad product and skates by on pricing power and switching costs and so on. They all focus on the customer, because if you don't obsess on the customer in China, you're going to die. And so I'm trying to apply that globally.
Perfect. Thank you so much. There's one other microphone here, so do you have 2? Oh, you have 2. Perfect. Okay, then we can keep it as it is. So who would like to ask the first question? I think there's one just at the back there.
Hello, everyone. Thank you for taking the time. Quick question. How did you all think about potentially getting help on the operations and, in Fred's words, the CEO side, so that you can focus as much of your time as possible on the investing side?
Yeah, thanks for the question, Gabe. So again, you know, there's no right or wrong here. Some people would go the outsourced route for the operations. I personally went in sourcing day one, but again, you know, that was allowed by our partners, I'd say. And so when I talk about the 3 hats, I spend, so when I think about the 3 hats, I spend, you know, most of my time on the first hat, and I'm very lucky that I have Kelly, who must be watching, because I was telling Rob that I needed to be careful for compliance reasons about what I say. You know, that takes care of everything from operations, infrastructure, compliance point of view. So I literally, and it's funny because what you ask is essentially one of the pitfalls, is that the guys that, you know, had regrets were around the operation because they underestimated the amount of time, depending on the jurisdictions that you're in, but certainly in London, and I guess maybe for you in New York, I mean, that's very cumbersome. And so having someone full-time that, you know, you trust and you know that there's not going to be any hiccups from an operations, trade reconciliation perspective, and that you have kind of a gold standard infrastructure is very reassuring and helps you really focus your time where the return on time is going to be the greatest. That being said, I know some managers that are, you know, that have outsourced operations and it's working.
Are either the other 2 doing outsourced, or yeah? Why don't you say quickly about outsourced, and then unless you have a strong point of view, Joan, we'll move on to the next question and I'll let you answer that one.
I think it goes back to, like, if you have a simple strategy, you're going to have simple operations. And if you have a complex strategy, you're going to have complex operations. So if you have a long-short strategy, a lot of shorts, then you're going to be dealing with trade breaks, locating borrow, and different prime brokers and all sorts of headaches. For me, as a long-only, just buying stocks, then it simplifies the operations a lot. And on outsourcing, so I have an outsourced CFO, costs about $20K a year, and they help with the managing your management company tax books, helping check your NAV every month for the fund, and various things like that, and it saves quite a bit of time. But overall, I thought the operations burden, at least for a fund my size and with my strategy, was not as high as I might have expected.
Perfect. Great. Who'd like to ask the next question? One at the front here. And then there's...
Hi, I'm Arni from Italy. So being an investor requires a constant evolution in terms of investment thinking, philosophy. But on the other hand, when you sell a strategy, you need to be very clear in order to sell. So I wonder, is selling a strategy somehow a limit to your personal growth as an investor? Thank you.
Well, I love that question. That's great. Joan, why don't you go first this time?
Well, I fully agree with you. So you have to be consistent in your investment style because your investors expect something that you have been telling them how you to select the investments, right? And the kind of investments you are investing at or in. So you have to be consistent, but you have that flexibility to be able to explain to your investors when you find a great investment opportunity in a field that is not the classical one you have been doing. And also you go learning, like Rob did in his 5-year, 10-year, 15-year letters. I mean, you expand and you grow your circle of competence. You learn more industries. You learn more investment opportunities. You start finding value in long-term compounders that you couldn't see before, you know, or you can see some short-term opportunities from a catalyst in a very specific company that you feel is very rewarding and you can take it. So you have to don't deviate. So basically you have to follow, to be consistent, but you have that flexibility with your investors and with communication to tell them, look, it's in the benefit of all of us to, or I've been learning, I've been growing, and I also can see these opportunities, and I can then add them sporadically, or maybe it will be something that will maybe become consistent. It's very, very attractive. So
that's awesome. Thank you. Do either of you two want to say something to that, or should we give some, try and get more questions in? Okay, who'd like to ask the next question? Claudine.
Hi, good morning, thanks very much. I'm interested in your motivation because I'm sure all of you would be able to earn a very good living working for someone else. So what cost benefit do you do when you decide to go out on your own? I mean, you Fred, has 3 small kids. What did your wife, partner say, you know, about you giving that up to start off on your own, and you know, how you see the risks versus the opportunities and the reasons that you're taking that on?
Who wants to have a crack at that one?
Thanks for the question. I think it's a very fair one. I mean, I remember when I essentially started, like a number of US LPs were telling me, I don't understand why there's not more partnerships like that in doing what you do in Europe versus the US. To which I answered, you know, speaking to all of my friends, you know, at the Hangisbury, the TCI of the world, the Edgerton of the world, where I'm like, yeah, you're absolutely right. The risk reward is not worth it if you only think about money. So you don't do it if you only think about money, because if you have a very good job in a very strong and performing partnership, then it doesn't make sense. You need to do it because you want to do something else. You want to do something on your own. I mean, an investor
probably
actually...
be independent as well, like, make your own decisions.
Yeah, and an investor asked me actually a very good question, which was, what would you do if you weren't doing what you were doing, like, in that industry? And I think it's a question about your identity and what you're trying to do. I mean, in my case, and again, no advice, I see myself as a builder, so I would have built something else in a different industry. So I guess you're right, it's not about money, it's about doing what you want to do, it's about building something that resembles what you do. Because, as I said, for me, one of the learning has been the path that you're taking, the teachers and the mentors that you surround yourself with. But there are things that you're going to take, that you're going to learn from them that apply to you, and some that you don't necessarily want to apply to yourself. And so you want to build so people that would do it for me would build something that essentially is like them and is also resemblant of their path. But again, it's very personal, but you're right. I don't think it's about money, because otherwise you just stay in a cushy job in one of these high-performing, investment partnership.
Great. I think we've got an online question, so Nick, over to you.
Hey, everybody. This is for anyone who wants to take a crack at it, but how do you think about finding the right partners for you that are aligned with your strategy and what you're doing, especially at the beginning when it might be hard to find partners?
Tim, do you want to have a crack at that one? Or if you need some more time to think, I can let someone else have a go. Joan?
So you can find two kinds of partners, I would say. One is the economical partner, the capital partner, and the other is just someone who you co-manage a fund, for example. So I think it's something very personal, and it depends on whether you want to make a project on your own, or you want to share that project with someone else, right? I think that is the main thing. And I would say for the capital partners, they should be, people who you can, they trust you, because in the end you are giving them returns, but they are buying trust, right? And they have to be people who trust you, and building trust takes time. And then it's also that they have to have this mindset of long-term investment. So they have to be wealthy people, which they will not need that money in 3, 2, or 5 years, maybe, right? So they can become part of the growing part of the project.
Perfect. Tim, do you want to say something to that?
I think for me, this question is more about the reverse, like what kind of partners do you not want to have? And so I have a clear thing in mind of that. And so some of the things Rob talked about in his letter, which I completely agree with, is like people who want a share of the economics for some money in the upfront, or people who are going to be fast money, or are going to be really like on your ass, like monthly returns, and something goes wrong, get a ton of questions. I think if you exclude those, then I think you're going to have good partners.
Great answer. I love it. I think we have time for one last question. I warned you guys it would go by very quickly once it gets started. Who'd like to ask the last question? Well, I guess I'll ask the last question then if no one else wants to. So where do you guys all want to be in 10 years' time? And maybe each of you could answer that. Yeah, start with you, Joan.
So my friend was saying, you are already living on the beach. What do you want to do in 10 years, right? So no, in 10 years' time, I would just have made a lot of progress in my investment process, I would say, in how to select business. And basically the goal that was asked before for me was to being the owner of great businesses and being able to grow my wealth through being the owner of great businesses. And also the intellectual challenge of an intellectual pleasure of this job is very, very important for me. I'm also the teacher at university because, I've always liked this cultural and this intellectual challenge, pleasure in my life. And basically in 10 years' time, I would see myself with a more well-known fund in which more people has been able to take advantage of a better management. That's
perfect. Good luck with that. Tim, do you want to go next?
I think the value of like being your own manager, and this ties into the earlier question about why start a fund, is like every investor has a different personality, and when you work for someone else, you in some sense have to conform to parts of his personality and how you invest and constrain how you invest. And when you have your own fund, you get to fully express your personality and really lean into the way you think, the way you invest. And so in 10 years, I hope to be doing same thing I'm doing now, just with more scale, and so I can meet with more management teams and have more research calls, but investing the way I want and in a structure where decision making can concentrate at the top still with me, and looking at the world that way.
Perfect. And Fred?
Yeah, I guess a continuation of, you know, what we said today. I mean, for me, it's just about continuing to build again along the three hats, constantly improving. Obviously, on the second and on the third one. So on the second one, obviously, I want to grow the team. When we're going to hire 1 or 2 investment analysts and hopefully soon partners this year, and kind of growth still to be manageable. So I have kind of a rule of thumb for the 3 hats, in the sense that I know you talk about your 10 companies. I mean, I'm more like 10 to 15, but like if you see there's a rule of thumb between the 3 hats, in the sense that even in like the company, I don't think I would want to manage more than 10 people in total, and that includes operations. And then, also in terms of the number of LP relationship, also having something that is manageable, and still doing what I love. So I guess, very similar to what was said, doing what we love with a bit more scale and sharing it with more partners.
Well, I think all 3 of you, your passion for investing really comes through. Great to see you got started. The best of luck for the next 10 years. And thank you for your kind offer to anyone else here in the audience or watching on YouTube to be able to reach out to you. So thank you, all of you. Thank you, Fred. Thanks, John. Okay, so we'll be back here at 10 a.m. for the Women in Investing panel. See you shortly.
part as well. My name is Amelie Vinall. Before we get into the discussion, I thought it would be a good idea for me to briefly introduce myself. I'm currently studying international relations at the University of Geneva. And as many of you know, I've been coming here as a guest for many years, by choice, not by force. And I'm a novice at investing, but I'm very passionate and very intrigued to learn more. And I think that's something that brings us all together. And that is the framework and also the aim of today's discussion. It's just demonstrating the passion that exists within this world, within this industry, and just discussing why it should attract more women and maybe why and how it has failed to do so far. And I would like to ask the first question to you, Alex, Fatima, and Sofia, just to briefly introduce yourself and maybe tell us about how or when you caught the investing bug. So maybe Alex, you can start.
Well, good morning. My name is Alex Douglas. Before we start, for compliance reasons, I just have to state quickly that the views and opinions expressed here today are my own and do not reflect those of my firm, Investure. And I also would like to thank Rob for including me this year. This is a really lovely event, and I've enjoyed participating, so thank you. So like I said, my name is Alex. I'm a managing director at Investure. We are an OCIO, meaning an outsourced chief investment office in Charlottesville, Virginia, which is about 2 or 2.5 hours south of Washington, D.C. in the United States. We manage the investment portfolio on behalf of a select group of U.S. endowments and foundations. Prior to that, I was at the Robert Wood Johnson Foundation. I was on the investment team there. That's the largest U.S. philanthropy focused solely on health. And before that, I was at the Georgetown University Investment Office. I had a rather non-traditional path to investing. My background is not usual for investors in the space. It was a bit circuitous. And that was, so in terms of catching the bug, really, when I was in college, I was very interested, like you, Amelie, in international relations, international affairs. And so for the first 4 years out of college, I actually did not work. I worked in businesses that were unrelated to the industry. And then, thanks to a very good mentor of mine, I wound up working in the investment office, rather by chance. And that was because I thought I wanted to go to law school. And I started in an operational and a legal role there, really to support my enrollment at Georgetown Law. And I was at the law program for all of 1 semester. I realized very quickly that was not a fit. Yes, that's a story for another day, but didn't like how my mind was being used, didn't like the way I was thinking. And Georgetown at that time was actually undergoing a CIO transition. And so it was during that time that I decided against continuing the law program that I transitioned over to the investment side of the office. And Georgetown's current CIO, who's a mentor and a friend, I actually followed in his footsteps. I wound up attending a program in the DC area that was essentially a political economy. It was for folks who were mid-career professionals, and you could build your own course of study. And so I wound up essentially thinking about where we were looking to make investments for Georgetown, and then studying those countries, and then traveling to do diligence on the ground in those places. And I absolutely loved it. And so I think that's where I caught the bug.
Great. Fatima?
Hi, thank you for inviting me to speak today. My name is Fatima Dickey. My office is based in New York City. I founded my small investment company about 10 years ago. I can't believe it went so fast. It's called Lagoda Investment Management. It's a long-only shop, global investing. I know when I caught my investment bug. It was when I had my first job. I was in investment banking. I didn't particularly love investment banking, but I realized I love reading the research reports. And then I realized that I can make money. And then when I basically speculated my way into an MBA and financed it through speculation during the internet bubble, I realized I was, infected. And I really, from that point on, I thought, that's the only job for me. It fits my personality, and I really want to learn more. I mean, the speculation was fun, but I'm pretty sure that's not what it's all about. And I made a choice to join an investment organization, a private firm, private wealth management firm in New York City, and spent 14 years there. It was a wonderful time. Most of the time, it gave me a lot of space to become an investor. I co-manage a fund. Then in 2010, I actually pitched and launched my own global fund. It really was my strategy, as it is today, kind of was born and evolved. But the bug was there, and the bug was about this is an empowering thing that you can make money and grow your wealth with your own, with your own brain, with reading stuff, with observing the world. And that was really the initial sort of hook. It is empowering and interesting. Okay, I'm in.
Thank you.
Hi everyone, my name is Sofia, and also for compliance reasons, I have to make a disclaimer that all views are my own today and not reflective of my former or current employers. So with that, I'm an investor currently based in Boston. I'm an investor within an international equity strategies that sits on top of a very large private wealth platform. My childhood dream was to become like an animator at Pixar, and then I ended up in investing. Quite a different pathway, but I was born in China, an immigrant from the age of 6 to Canada. I studied statistics actually in university, also not a lot to do with fundamentals investing. But then I ended up becoming an investor sheerly because I fell into it. When I was in college, I did a couple of clubs in investing, kind of gave up after 2 years because I was more interested in international relations. I did 2 internships on Wall Street in sales and trading. That was about FX options trading, credit structuring, like converts trading. Not a great personality fit. So when I got to my last year in university, I was freaking out. Like, what did I want to do with my life? So I took over 30 interviews across consulting, tech, so product management, and all of the verticals within finance, all of them. Banking, private equity, investment management. And I was very lucky because there was a team within Grantham Mayo Van Otterloo, or GMO, in Boston that was hiring a junior analyst, and I went to the interview. And I literally took the job because I loved the interview process. I was like, wow, this was an interview that really made me think about businesses. Never really thought about that before. It had a really fun math component that I loved. And the people were very young, and they're like, come join us. We're gonna teach you everything. You don't have to know anything about finance. All we promise you is that we will give you as much responsibility as you can possibly handle, and you get to travel. I'm like, I'm in. And I guess from there, the rest was history.
I feel like there's more unconventional ways to becoming an investor than there are conventional, so great to hear. And maybe very briefly, just talk over your methodology or how you invest. Maybe with Fatima, you can start.
Okay. Well, I really am a long-term investor, and for me, there are some things I don't want to go too much into, all of the particulars of my strategy, but I really basically view an investment like a journey. And I ask myself, do I want to go on this journey with these people? And why are we going on this journey? And so, there are essentially 2 types of companies in my portfolio. The ones that have already proven that they are very successful, and I want to join their caravan and basically join this compounding expedition. And the second part of the companies where they're going on a journey because there is a treasure, and you have to get through the jungle, and you ask yourself, okay, do I want to go with these people, and who are they, and why? Why are we going? Why is it worth it to spend 5 years joining this expedition? And so for me, I call my strategy owners and dominators, as well as investors and operators, and these are the lens through which I view things. So, for me, owners, just like for Rob's, are very important because they're the leaders of the expedition. And if you're gonna decide to go through a jungle with somebody, you're definitely gonna want to know that the leaders are, gonna be the people that, first of all, I love the asymmetry. I'm just gonna join the expedition at the end of the caravan. I'm not doing anything, but good things and bad things can happen to me because I joined this expedition. So who is the guy leading it? And I want to know that, for me, that's 5% of my portfolio, and for them, it's their baby. It's everything, the entire wealth in the family, maybe, and I want to know other things. Is it what I love is, for example, finding great problem solvers. On the way to here, I was reading this book by Brad Jacobs with a little pompous title, How to Make a Few $1 billion. But, you know, I invested in Brad Jacobs 5 years ago, and I thought, wow, what an amazing problem solver. Because, again, if you think about it this way, you know, I want the leader of my expedition. There will be problems on the way to this treasure. And I really want them to solve problems. And he has an amazing quote there, which I knew when I first investigated him. He said, you know, early in his career, a mentor told him when he was down because there was a problem that he was trying to solve, a mentor told him, look, Brad, I'm paraphrasing a little bit, you're in business, you need to find problems, actually embrace the problems, enjoy the problems, and then solve the problems. And I was like, I want to be with this guy too. And that's kind of how I think about owners. I wanted that feeling. I trust him. I want to be with him. I'm going to therefore go on this expedition. People think that you join the owners because they have the vision. But again, I think a lot of people can have the vision. I worry more about, that's a great vision. I like it. But are they going to, you know, solve problems? And the other thing is, are they the kind of people that will create intelligent organisms? So I like owners, but ultimately, I'm looking for intelligent organisms. So I like owners who know how to create one. Because sometimes maybe they step down from what they're doing, and Brad is no longer with XPO. I think he created an intelligent organism. So really, the way I think about due diligence and what I'm looking for is, I'm really looking for owner-operated companies around the world that I'm looking for intelligent signs of life, you know, out there that are created in these organizations. Companies that dominate their areas, people who are either have the successful recipe already that I can just join up, or people who are looking to create new ones. I mean, today we have Trupanion CEO. He's telling us he's looking for nirvana, for example, right? So, you know, we're all looking for something, and, you know, it's a collection for my portfolio of these businesses around the world, large, medium, and small, developed, less developed, and there's some crazy, amazing people who are totally looking for something that hasn't been invented yet. And, you know, get together this collection and pay attention to who's running the shows in each, and do they really have advantage? Do they dominate something? Do they have investment recipe, and who's guarding it?
I think I'll stop you there then.
Stop me.
Ask Alex to take over.
Sure. So unsurprisingly, my view of all this has been informed very much by sort of my allocator seat, if you will, on behalf of institutions. I will note maybe up front just quickly in terms of our business model, because there are different forms of OCIO out there. We are, the way we approach our portfolio is we manage 100% of our clients' assets. We have full discretion over them, and we don't customize accounts. So even though it's an outsourced model, we are very much thinking as investors. We're not just consultants alongside our clients. And of course, when I was at RWJF and Georgetown, that was the case too, right? You're serving as a fiduciary. But in broad brushstrokes, what I'd say in terms of my philosophy, look, it's maintaining a long-term perspective on things, just given sort of the institutions that we serve and that are looking to exist into perpetuity. We're trying to maximize return. While managing around the risk tolerance and time horizons of those institutions, and in keeping with prudent practice. I think, you know, there's an importance for me of having a macro awareness. So, you know, having that top-down perspective, but simultaneously really focusing on the fundamentals of the risk-return contours of each opportunity. So when you think about sort of the global set of opportunities you could be allocating to, where do you want to allocate capital when it's limited, and then at the end of the day, look, this is a business of people, and so you know, people matter and process matters.
Thank you, Sofia.
Thank you. So I guess for me, there was like two parts of my career that really influenced how I thought about investing. And the first part, I actually really want to thank Rob, because when I started this investing career, my boss met Rob on a trip to China and was like, Sofia, there's like one thing you read, like you need to read Rob's letters. And so my investment philosophy from the very beginning was very, very focused on finding really good businesses, you know, backed by really, really great people with amazing moats. So it's like no different than a lot of, you know, true value investors out there who are looking for great compounders. And then the second part that really influenced my career was my time actually at SoftBank when I was working with more operators, founders, getting into the nitty-gritty of companies, looking at companies that were, very young, immature. How do you evaluate those companies? They can still be great companies. They're still building their moat. They're still kind of coming out of that moat. They're trying to figure out real scaling problems. And that really got me to think a lot harder about truly understand management teams, execution. A company is just, it's organic, just like Fatima said, it's made of people and teams, and you want to find great businesses that have a really deep bench who can solve a lot of problems. There's going to be short attacks, there's going to be regulatory changes. How do you navigate those problems? I always look for companies that either have moats that will go through really tough times, or really solid management teams that are able to pivot in different directions when things go wrong. So I don't discriminate between, personally, I'm an angel investor as well, so I've looked at everything from 0 to 1, from 1 to 10, from 10 to 100, and those who are 100-year-old companies in Japan that are going through transformations as well. So being able to price that risk, being able to think about where they are, how you think about the entry price and what you're getting out of it, those all kind of go into an investment process. And right now, I have to admit, it's still a journey for me. My investment philosophy, it's still growing, it's still evolving. It's still changing from the way the world works, it's dynamic, and from all the different investors I learn from. So it's still an ongoing process that I'm kind of going through.
Very good. My next question is going to get right to the topic of this discussion, and it's the following. Why do you think, or seeing that it is so male-dominated, where does the industry kind of fail to attract women's attention? And whoever wants to answer first can go ahead.
I'm happy. Maybe I start with an energizing anecdote, because that actually happened to me. And so I actually didn't know I was a woman portfolio manager until a particular moment in my career. I was already a managing director, and at this point, actually managing my own fund, which I created the strategy for. So I was definitely, not a young person early on, but somewhat advanced in my career. And I remember this was 2012. I was underperforming, and some people were mad at me. And this other managing director came in and said, basically saying, you don't like your performance, what's happening? And at some point he said, you're just a pretty face. And I thought, wow, that's a very not nice way of describing someone's performance. And I thought, I think the universe is telling me I'm a woman as well as a portfolio manager, because this would never happen. So, it wasn't anything big in the scheme of thing, but I think as a woman, sooner or later, you're on this journey of being a manager, and you don't think of yourself. You're just following your interests, your passion, you're following what you're good at. And then, there are certain problems, certain things that happen that you become aware. Well, in addition to that, you're a woman as well, kind of a thing, And that makes it a little bit harder. It doesn't kill you, but maybe that there's some additional things that happen that make it a little bit harder.
Yeah, I might phrase it just as challenges rather than what attracts women or not, because there is a lot to love in this industry. I love thinking globally and having to keep up with a range of industries and geopolitics and secular trends and thinking quantitatively and qualitatively, right? That analytical rigor is absolutely a part of it, but there's also discretion and emotional intelligence and discretion, right? And so there are many parts of it that are just wonderful, and I think can be of interest both to men and women. I think in terms of challenges, though, for women, in general, a couple things. One, I would say, is examples. So they're just, because historically it has been a more male-dominated industry, there aren't that many women that you can point to that are in, places of power. And if you don't see yourself or someone who looks like you, doing something, it's harder to imagine that as a career path for yourself. And certainly, and this may be a US-centric comment, but in the US, the recruiting for the street starts very early. People start getting internships freshman year, sophomore year, they start, and so if you didn't know that this was, like me, no one in my family had ever done finance, it wasn't kind of on my radar as an undergrad, you're sort of behind the 8 ball, even when you graduated from school, if you haven't had internships and done these things. And so I think, not having the example and therefore maybe starting out and then you're kind of on your back foot. Another thing I would say is, just in terms of general challenges, I think there's a little bit of a disconnect between the way women are socialized, and again, this will be very specific by country and culture, so this may be a very American perspective, but there's a little bit of a disconnect, I think, between the way women are socialized when it's in a non-business context and what is really necessary in an investment role. And so, for example, I can't tell you, and I know Fatima and I have talked about this, where there have been a number of young women, over the course of my career that I've spoken to. The thoughts are there, the opinions are there, they're very strong, they're very talented. And I've said, speak up. When we're in an investment community, don't be afraid, project your voice. Don't be afraid to give your opinion, even if you don't feel like you have a 100% view of exactly, what something is, or you feel like you don't have all parts of it in your mind completely ironed out. And I think that's something where, sometimes there can be a stylistic element that, for better or worse, we're in an industry of type A go-getters. And if you're in a room and you don't project a certain amount of confidence, or aggression is the wrong word, but just you cannot be taken seriously or be viewed as not having a viewpoint, and sometimes that's just stylistic. And so I think there's a little bit for women, sometimes there's this disconnect between how you would behave if you were in a non-business setting and how you behave and need to behave, when you're in the business world. And then lastly, I'd say mentors are very important. I think it was Fred on the last panel who made this point, and I completely agree that, at the risk of stating the totally obvious, men relate to men differently than they relate to women. Women relate to women differently than they relate to men. And so when you get, I think, in the early stages of the industry, you'll see a lot of young women. But when you get to that inflection point of where the talent, where you really need to get sort of moving up in your career, a lot of times that's dominated by men. And I think that's just sometimes not as easy or natural, a greasing of the wheels, if you will, for women.
Sofia, just quickly, I'm curious because you say you do you research a lot in Chinese markets, Asia, how that differs from maybe our predominantly Western perspective.
Yeah, so it's interesting. I never realized I was like a woman in a role until really I started in the workplace after my first job in the US. My first job was wonderful, so it almost protected me. But being a child growing up in under the one-child policy in China, my first conference in Asia was incredible. 50% women and men, like so many women out there in the investing industry. And I think growing up Chinese, it's not like my parents never told me, oh, you're a woman, you can't do anything. They only have one child. Like for most Chinese people, that's the social welfare right there. You better invest just as much into your daughters as your sons. And that's why we're always pushed into science, mathematics, and engineering majors. And what my parents told me was like, engineering is like a really hard industry for girls. Why don't you go into finance? That seems like a great job for women. So I actually didn't even know that there would be issues, because my mom said, yeah, engineering, that's hard. That uses too much brains. You're coding all the time, not social. You should go into finance. I was like, yeah, great. You get to talk to a lot of people. The job itself is very wonderful. So from a Chinese background, it's almost a better culture, I thought, in China, or at least what I saw when I was in Hong Kong, Shanghai, than when I got to, when I really started to get to know the US industry, which I think one thing I wanted to add for the reason why a lot of women don't probably, even if they know about this industry, don't want to continue in this industry, it's just because there's not a lot of places with amazing culture. It's so funny. It's a job that is 100% human capital, but some of the worst human capital management I have ever seen in my life. As a woman, I was told when I was too soft-spoken, you need to be more confident. And then when I got my confidence, I was told, you're aggressive. Tone that down. It's just there's no middle ground. You can't. Your bar is just set so differently, and so as you try to move up, there's almost an invisible ceiling that because you're a woman, your bar is just very different.
Yeah, and ultimately when you move up, you have to be prepared to break some male egos. There's a lot of money and a lot of male egos floating around in this industry. and you run into it eventually.
Last question before I open the floor for your questions is maybe just very briefly, and I know this is an extremely difficult question, but if there's like young women watching this, listening to this, what is kind of the main takeaway, or if they are slightly interested but are not sure whether they want to go down this route, what would be your advice for them?
My advice would be it's an extremely empowering skill to be able to understand how to manage money yourself, how to create wealth with, your brain. So it's extremely empowering, extremely interesting. You can learn a lot about the world if you're in this job, and it's not all Wolf on Wall Street. In fact, not at all. So, don't watch TV, don't watch the movies. They don't tell you anything about this job. Sometimes I almost feel like I want to make the movie about this job because there are no good protagonists, except for Warren Buffett. If they make a movie about him, that would be a great movie, but he is not a woman either. So, don't watch TV, don't watch TV, yeah. Yeah. So empowering, super interesting, and absolutely a job for a woman.
I guess what I would say is the job itself is wonderful. The job description is like you get paid to learn about everything and anything and travel everywhere and meet really cool people and eat great food. There is, if you look at the job description, it is almost like a dream job. I feel so entitled to be here. So if you're someone who looks at this industry, look at the job description, and then if you're in it and you're like struggling, think about, is it the job that I actually dislike, or is it the environment I dislike? Because you have to really differentiate between that, because people who are toxic, just like Charlie Munger and Warren Buffett said in their last AGM, that is the worst. That can make you really hate something. I almost gave up on this job because I was in a very toxic environment. And then I realized, I love this job. I just really didn't like the people I was with because they made me feel awful. And then when you start to think like that, I think you have to be in survival mode. You're like, well, I need to surround myself with better people and stick it through, like tough it out, because it's truly rewarding at the end.
I would echo that completely. I think number one, you can do it. Number two, you are capable. It's a great job for a woman. And if you like to think globally, if you like to think quantitatively and qualitatively, if you like to meet some of the most interesting people that you ever have in your life, and to be really challenged and to continually learn, this is the job for you.
Great. So ending on a positive note, if anyone has a question, right at the back first, maybe, or.
Could you enlighten myself and some of the other men in the room some of the inherent advantages of being a woman in this job?
Okay. Well, this is how I think about it, because I do think about it. I think that as a woman, I often thought that I couldn't be, for example, maybe an activist manager, because I don't think, well, I could do your job better than you. I'm nicer, in fact, and I also think that I pay attention to a lot of intangibles. So my approach to doing due diligence is not just numbers, 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 numbers. It's really, who is this person? How can I know that he owns the company, but really just how could I trust him? Could I like him? Again, this idea of an expedition, what I get on, it's really a lot of valuing things that are extremely valuable, but they're actually not valued. So I actually think inherently, when I think about my strategy and what I do, is that whatever can be quantified is quantified already. So you can pursue things that people don't like at a particular moment or don't value things. And I value things like commitment, determination. I ask myself these questions. Are these people committed? Do they seem determined? Do they love what they do? And I value that. And I think that is the kind of a point of view that is maybe a little bit different from a man that's going to just maybe more likely to do just the spreadsheet. I don't know. And then also loyalty. I'm more likely to be a long-term shareholder, I think, when I think that people are really making a huge effort. This year, I wrote the best Christmas card to the worst performing company in my portfolio, and I told them specifically, I value you. I know the market doesn't, but I see how you guys are trying. They're doing amazing things. And instead of a man saying, you know, hey, you're the worst performing stock in my portfolio, please explain. So I think those things help. And you know what? They were so ecstatic receiving this Christmas card. And you know, they're building a business and they're going after an amazing treasure. And I think it was the woman in me that wrote that card, you know.
I do think women have a differentiated perspective in many cases to men. And again, that just goes to, you know, our brains are different. We relate differently. That also probably is a function of the fact that, again, I have a non-traditional background. So I actually think that's worked, you know, that's not specific to being a woman, but that's also been helpful. I do think also that women have, and I hate to speak in generalities about or stereotypes because it's just, it really doesn't, it's not helpful in many respects. But here I do think that women have, oftentimes, they have soft skills in a way that, call it diplomacy, call it treading lightly, maybe for some of those reasons I mentioned about socialization, sometimes less threatening, whatever that might be, which could also be, you know, the flip side of that being that you can be viewed as not serious. But I think it can also help people lower their guards a bit. And so in an environment where it can be, it's, you know, it's highly competitive, type A's, et cetera, I think sometimes women can be very useful in terms of getting information that would otherwise be missed, or seeing nuances that others might not see, or greasing the wheels. There's something to be said for just connecting, you know, if people lower their guards, you know, that allows for communication in a way that could otherwise be missed.
Absolutely.
Is there Okay, go ahead.
Yeah, I was listening to this fact that what are the advantages of women, you know. And I think that overall our industry is a complete failure, you know, the equity management fund industry. Most of the funds don't outperform the index, so we should open the door to women and have a chance on that, you know. I mean, male-dominated for the last 30 years, not a good outcome, so what can we lose?
Ollie in the front, and then there was someone in the back. That was first.
Thank you. There's a really cool organization in the UK called Girls Are Investors, or GAIN. Just interested in any organizations like that you know, can really promote women investing, particularly as women are coming out of college or even in the sort of late stages of high school that you've come across, you know, that you would recommend to budding investors.
I know in the US there's an organization also called Girls Who Invest. They also help out a lot of high school students who are interested in investing. But I really actually think university, at least in the US, is a very, very great fertile ground for doing that, because a lot of your upperclassmen will want to transfer their knowledge to underclassmen who are willing and looking and interested in that. So that is a great ground. Don't be turned away by you know, if you're intimidated by that environment, because when I looked at all the investment clubs out there, like who would be most helpful to me as a woman, I joined an all-male investment club because I was like, you know what, like I also want to break into that circle. I want to talk to, be in an environment I'm not comfortable with. So there's a lot of different good organizations out there, universities, good, yeah.
One of my favorite saying is charity starts at home. And so if you think that you have a chance to have a girl as an intern, take it on. I take a lot of interns. 80% of them who come up to want to intern with me over the years have been guys, 20% girls. But whenever I get a chance to take on a woman intern, I basically remember charity starts at home, and there's another girl you can, you know, learn about the business. So actually, let's all do that.
I was actually going to echo on Girls Who Invest. That's the US, it sounds like maybe the US equivalent to what you mentioned. And what's nice about them is they'll actually bring in, when I was at the Georgetown Investment Office, for example, they brought me in. So they'll target women in the industry and have them come and talk, so you can sort of relate to the students and help them understand things. The investment clubs are also terrific in the US. It's great training ground. So just in terms of sharing ideas and being in sort of a mixed company sort of thing, that's terrific as well. And then in the industry, there are a number of groups. There's 100 Women in Hedge Funds. There's a whole slew of organizations that kind of focus on women in different asset classes, et cetera.
Yeah, go ahead.
Okay, well, thank you very much. My company, 6 out of 7 are women, and then I happen to be the only boy in the company. And then until a couple months ago, we hired a boy because I was a little bit worried maybe my wife probably thinks a little bit different ways. But then it's China, right? And the China or maybe the Southeast Asia, I think women presence is much greater. And then in particular, I was really surprised, but then if I go to AGMs in China, more than half allocators are women. And then I actually didn't notice initially, but I realized a lot of my friends in allocator space are women. And then it was no difference between men and women. Right? And then, so I kept thinking about this, and then how we can actually, help to change this industry as well. And then I also found that maybe allocators, I think the percentage of women is relatively high. If I look at the CIOs in U.S. endowment foundations, there are more female, the CIOs, and I think that was pretty encouraging signs. And then, so we actually, organizing, it's called Half Sky Project. Just, there are a lot of women, the allocators, and then they're creating some, the organizations. And then, but my question is, so one of my partners mentions that, so she, she's a woman, and then she said, I don't want to be segregated from men, right? Because, we have a lot of, women-focused organizations, but then it might be a wrong approach because, we want to integrate, the men and women as opposed to just, the segregating women. I don't know the right answer, right? And then, but then I see a lot of potentials by changing these industries. And then, now if you look at these rooms, probably 70%, 80% men. And then I think hopefully next 20 years, it's going to be changed. So just curious what you think.
So just to be clear about the question, whether it's better to be segregated or to have the support groups, is that right? And why maybe so many women in an allocator role? Maybe I'll tackle the first one, having been in the allocator role. One of the things that has been very meaningful for me in the seats I've been privileged to have has been working on behalf of the missions of the institutions we serve. And so I think, I can't speak for all the women who are in that seat, but I will say one of the very special things about the allocator role is that, we are making, we're trying to increase a pool of capital, not just for the sake of increasing a pool of capital, but, in support of student scholarships, faculty, the educational and grant-making, sides of the clients that we serve. And when I was at Robert Wood Johnson, on behalf of grant-making activities in the health space, and in Georgetown in support of the university. So it's a very fulfilling. It adds sort of that piece to it. I don't know if for sure if that's something that attracts all the women that you've seen in that space, but certainly for me, that was a big piece of it. In terms of being more segregated versus having the support groups, I don't know that there's a right answer to that. I think it's a little bit of both. I do think what I can say is that, at least again from my seat, it has been helpful to have you are integrated in most instances. So having a support group or having women that you can rely on or speak to or have lunches with has been hugely helpful. And because I think sometimes in a conference setting we're more dispersed in the crowd, just given the ratios, it's nice to have sort of a forum where it's just it's just women all together. So, but again, I don't think there's a right or wrong per se to that.
If I may just quickly add. As a younger perspective, the idea is not, and I think well, not all women, most women will agree on this. The idea is not to promote women over men. It's quite the opposite. It's to make sure that it's like not equality, equity, that they have all of these equipments which previously they have not been able to access. So it's very much, it's not about promoting. It's just making it a bit more equitable.
I want to add on to a point that you mentioned, Amelie, is that a lot of diversity and inclusion initiatives that start out as a good cause of like wanting to increase women at the bottom levels to make a 50-50 class, when you make it so that when women enter a program thinking they got there because they're a woman and not because they're meritocratic, like that actually makes, like you get so much inferiority complex from that, because you're like, oh, I didn't get here on my own merits, I got here because of my gender. And that actually, is not a good way of promoting women. And to Amelie's points about, it's about just setting the bar at the same place for men and women.
Maybe just one additional point would be when I think it's very important, especially around diversity issues. I think sometimes there's such a focus on making sure that whichever population, you're speaking about women in this case, it can sometimes feel like to the exclusion of, so to your point, to the exclusion of the other gender, for example, and it doesn't work unless it feels like it's beneficial to both, to all participants, everyone involved, right? And so I think as a starting point for any conversation on this, it has to be that it's not just specific to women, but that everyone is involved in the work of this, and it's beneficial to everybody.
Okay, I think one last question.
Thank you all for speaking today. So a lot of you and people have asked about different organizations that support women getting into the industry, whether it's investing, allocating, and I think that's really valuable that, a lot of men here are looking at that, but I think a really big hurdle is to some of the points you addressed, like how men relate and interact with them once they're in these roles, and talking to other women in different roles in finance, I was telling someone this earlier, but they feel like sometimes maybe they're at a disadvantage because the men don't want to like overstep, so they on work trips like won't ask to get dinner one-on-one, and they might then be disadvantaged when it comes to, I don't know, being selected for a project because they don't have that like bedrock personal relationship with men at their different companies. So since we're in a room with mostly men, I'm curious if you guys could share things like ways that men here can change that way that they interact with them at their different firms to really be a woman's advocate, and not in a way, to your point, to check the box of having women in these industries, but to really help them start from the bottom and grow up.
I mean, I think for my own personal career, I would say it's a lot about like sponsorship. My first managers never saw me as like Sofia, the female investor. They saw me as Sofia, the investor. Is she performing? Is she not performing? How do we help her improve on the things she needs to improve on? And when she gets there, let's help elevate her, whether it's in terms of like always fighting for my compensation, always fighting for my promotion. They just never treated me any different than the male colleagues I had, and that was probably the best thing. It was that everybody is an investor, whether you're a woman or a man. We're just all very unisex when it comes to our careers, and not putting any light on that, I think, was actually very positive for my development, because I was like, oh, okay, I have to perform. Okay, this is what I need to do more of, less of, and it just helped me build confidence that way.
Yeah, I agree. That's why I gave you that example when somebody said, well, the pretty face, a man would never get this kind of criticism of his performance. That's why it was, that was kind of a little hurtful. You could criticize my performance on all kinds of points, but make it about that. So you run into some few points like that. So don't look at us as, something special, women that need to be special hand glove handle. Just we want the same opportunity, and we have the same interest, and yeah, this job is still more male-dominated, but there's no reason for it. I have chosen to create, by starting my own firm, the environment that would be perfect for me, and it turns out to be a small firm that I'm in charge of, because I couldn't find that kind of great environment for myself somewhere else, but that's not the only solution. So I'm sure such places exist, and I'm sure as more women become good at this job and pave the way, maybe institutions naturally will want to attract them more, incorporate their point of views more. Yeah.
Alex, I'll stop you there, and maybe you can answer the next question.
So I wanted to go back a little to those attributes that we talked about before about male and female investors. So what I've gotten is that, you know, we do have in some parts different attributes that we could, you know, use to make our jobs, you know, better. And so what I've gotten from this is that it's also a complementary kind of collaboration that we could form. And I wanted to ask you whether you think that if we actually invoke this complementary collaboration, how we could benefit for the future of investment.
I just want to make sure that I understand it. So, but when you say invoke collaborative, what exactly are you referring to? I'm not sure.
Well, I feel like we could use those different attributes to our own benefit, you know, to make the environment also more empowering for the two different sides, and also use those different attributes, you know, to make the companies stronger in general.
Yeah, I mean, I think absolutely that's the goal, right? And I think there has to just be room for women and men both, right, to bring different skill sets to the table. You know, the teams that I've worked on, I feel like I've been quite lucky in that I think different people have different strengths that they bring. And so whether or not it's a woman or man, I think identifying what it is that an individual brings to the table that is unique relative to everyone else around the group is hugely additive. And if you can pull that out, you know, you'll have the best possible outcome.
Yeah, I mean, I'm running a shop where I have one analyst, and if I was in charge of a bigger investment firm with a lot of men and women, I would exactly think about it this way. If I thought the women were better, let's say, at valuing the softer things and they were nicer, I would try to use them in due diligence and interviews, absolutely. And maybe I would use some other more male skills that are better at, I don't know, whatever you can imagine. I would use those skills for that part of due diligence process. There's a lot of ways to get to the final goal, which is let's find really great, amazing investment opportunities and use basically our personalities that are different, our points of views that are different, our skill sets and strengths, and they come in all shapes and sizes, a woman and female and more male, and make a mix that gives us the best outcome. And organizations that are okay with that, that are not, you know, well, this is a man-woman, this is, you know, ego sort of battles, but rather let's mix it all together and create a best cocktail. I think probably we'll do better than those that kind of don't think this way.
Yes.
And I might just want to add one other thing, and it also speaks to the last question, which is just finding areas of commonality that allow you to feel connected to your teammates, whether it's a man or a woman. And so the same thing about the fear about overstepping, you know, and again, this is probably a very American comment, but, you know, you might have to look beyond football, or you might have to look beyond whatever, you know, golf, or whatever the very common things are, but it could be music, or it could be, you know, so finding ways to connect, you know, across genders, and really trying to understand the abilities that someone else brings is really the key, I think.
Do you have anything to add or no? Okay, last question, no pressure.
All right, thank you. I have a one-year-old daughter, and I was wondering what you would say about how I should raise and socialize her to give her an equal opportunity in male-dominated professions. Thank you.
No pressure.
I mean, I would say, from my experience, what you mentioned before, when I have a young woman intern, one of the first things I tell her, I can't hear you, speak up, because that's. So I would tell her, look, you know, speak up, don't be afraid to be louder and to you know, maneuver through this world, assuming that everybody else knows more than you, because they don't, and you know, develop confidence. Confidence is important. backed up by obviously skills and knowledge and everything else that goes behind it, but it's sad when everything else is there, but there is no confidence. And I think that's more likely to happen with women rather than men.
Yeah, so I mean, I guess I would just say from my own experience, because I have the best parents in the world, and the way they raised me was to always support my curiosities, you know, encourage me to do the things I love to do, teach me discipline, aka piano, and do the things I dislike to do. But you know, it paid off. I learned discipline, so thank you, parents, for that. But just, I think a lot of just encouragement and teaching her that there could be other voices in the world. There could be other ways. Stand your ground. Always never compete with others. Compete with yourself. There's always going to be people better than you, but you are you, and just be happy. And I think like if you push, I mean, my parents are always like, can we write you a note because you stayed past like 11 p.m. You need to go to bed right now for homework. That's not important. Like, I was always taught to motivate myself, to find what I like to do, to be with people who made me truly, truly happy, and to think about the types of things that I did and the people I surrounded myself to have a happy, happy life. I honestly think that was the best advice I ever got from my parents. So.
And lastly, I would maybe just say expose her to as many things as you can, right? As many different ways of thinking and expressing herself and exploring the world. And, you know, because at the end of the day, hopefully in that menu of items, it's all a menu, right? And hopefully you find something on there that really gets you passionate and excited, and that's the end goal.
Okay, well, thank you very much to you three, and thank you for the questions.
I've been at GHR Foundation for about 7 years. It was a new effort, so a new investment office. That's the second time I've done that. Before I was at GHR, I was at Carleton College for about a dozen years and was their first investment hire and built out that portfolio. I've been in this allocator role since about 1998 or so. Before Carleton, I spent a couple years at an investment consulting firm working on equity strategies, and then I spent 5 years at a large pension fund. So that's a brief background.
Thanks also for the great event, and thanks for having us between the women panel and the skiing. So it's a bit tough for us, but let's do the best. I'm Thomas Berchtenbreiter, CEO of a Munich-based family office. At the family office for 15 years now. Worked for Gesinter in a pension fund before, and took over the CEO role 3 years ago. And we invest globally across private equity, public equity, absolute return, and a tiny fixed income allocation. And yeah, try to be really long-term investor and always aspire what the US endowment model is and was, and kind of I really try to pitch ourselves as being the diversifier to a US endowment-heavy investor base.
Thank you. Sargent, McGowan. I help manage the endowment for the University of Virginia. I've been there for about a decade, and prior to that, I was a fund manager for a firm called Investure in the US, helping to manage a global equity fund. We at UVIMCO, we're about $13.5 billion. We have a pretty traditional kind of portfolio, about 45% privates, about 25% in public equity, long only, long bias public equity. That's a strategy that I lead, and kind of the rest spread across credit, fixed income, and a few other strategies. And yes, we have a pretty typical approach in our world in the endowment space, tend to be very long term. Nearly all the capital is invested with external managers. And within public equity, within that kind of 25% sleeve, that's spread across maybe 15 to 20 relationships.
Great, thank you. Do we have one more microphone? Is there a spare one around? Or, cause in the last panel, everyone had their own microphone. Just there, great. Is that working?
Test.
Yeah, great. Good. Yeah, so thank you all three of you for introducing yourselves. So you all have probably interviewed hundreds, if not thousands, of managers over the course of your career. I'd love to hear, and I'm sure perhaps as an organization you have your criteria, but as individuals you've also certain things you kind of look out for. I'd love to kind of ask you to speak to both of those points. So perhaps from a sort of more from a kind of your organizational perspective, what you're looking for, but maybe also some insights of what you personally look for in an investment manager. Do you want to go first, Saland?
Yeah, sure. I think at the highest level, there are a couple things that we're thinking about. Because we're investing with external managers, we don't tend to have a lot of turnover in the portfolio. The two big questions we're asking ourselves in really every meeting is, can we understand why a manager has and should be able to generate kind of excess returns over the long term? And that's, as we all know, that's the answer is generally no, so we need to understand why it could be yes in this case. And then the second question is really around partnership. This is someone that we're going to be invested with hopefully for a decade or longer. And so is this a person, a team, a group that we feel comfortable with and want to be partnered with for the long term? I guess just to the second piece, the things that we're thinking about or that I'm thinking about when sitting down with a manager for the first time is really understanding. You really just want to see that passion for what they're doing. I think this group and Rob, certainly you and the people that you've attracted in your network, you're not short on that, right? There are a lot of people who are that are really kind of doing this more to make a living and to make money, and that's fine, but that's not necessarily what we're looking for. So that passion, and then understanding how their investment philosophy and what it is they're looking for, that can be expressed in many, many different ways. We try not to put people into tight of a box, but we do want to understand what that philosophy is.
Awesome. It fascinates me, that answer, just to briefly interject, that you're really looking for transparency to understand, what the portfolio is, how the alpha is generated. Because I remember when I started out, funds, especially hedge funds, would be incredibly secretive about their strategies because they didn't, they had this amazing money-making machine in their view, and they didn't want anyone to sort of figure out what the secret is. So it's fascinating that you not only look for transparency, but you value it. Thomas, maybe the question to you as well.
Yeah, for us, we kind of defined our gates. So that's kind of governance, alignment, team, execution, strategy. So I think on the governance alignment, obviously skin in the game, being really partners for us long-term, having one strategy, being really focused, do what you say you do, and really kind of have strong, also aligned investors. Because for us, being a small investor, it's always hard if people run for the door at the worst time. On the team side, I think it's primarily character. So if you do the beer check and think, hey, do I want to have a beer or water with that guy at the evening? That's really a hurdle, because kind of there are going to be bad days, and you're going to have to discuss the LPA or whatever kind of things going wrong, and you don't want to do that with people you don't like, and you kind of have doubts in the beginning already. So strong character is really important. And strategy is really kind of what's, like on the public side, what's your company, what's your focus, what are you looking for? Kind of, if you look through the portfolio and look through the 10 names, what is the common denominator, and why do you invest? And that can be different things, but you have to have your strategy and focus. And execution, I think it's not just track record, but really kind of how you execute on the strategy you put out in your pitch book.
And if I can pick up one point there as well, I love the idea of liking the people you work with. I think there's a school of thought, it's better if you don't like people, because then it's easier to become objective. But my experience as well has always been that, if you like people, that's a very good indicator about their character and the potential for long-term partnership. So thanks for mentioning that. And Jason, over to you.
Yeah, sure. So I think the first thing I would say is I think it's just really difficult to select emerging managers. It's something that we're open to, we've done in the past. But I've been doing this for a long time, interviewed hundreds, if not thousands, gone through diligence processes. It's so hard even to pick a long-established manager with a good track record of alpha. I've been, made mistakes and disappointed over time. With an emerging market, you may not have that track record, or it's harder to suss it out. So maybe a few, and I think they echo some of the other panelists up here, but a few of the things that I look for is really a learning mindset. We all make mistakes over our careers. I've made a ton. It's how I've learned. I try not to repeat them. Motivations are important, and it shouldn't be all about money. It's really difficult to suss that out, I think. So that motivation for wealth really has to be balanced. It can lead to suboptimal decisions that are not in the interest of your partners if that is too much of a motivator. Just really a ruthless focus on outperforming the passive alternative over an appropriate long-term time period. And designing your firm, your team, even your personal life to prioritize your ability to focus on investment performance. Ethics, integrity, valuing your partners. There's a school of thought I've placed more value on, liking and wanting to be with my partners. That's become more important to me. I've found that that's led to better outcomes over time. A focus really on what you can control, which is not market performance. So tending to worry less about beta and just more about what are my underlying companies, and having a focus on that. Temperament, many can analyze a business and make good judgments, but you're going to encounter challenges. So how you react in your portfolio, how you react within your organization, to your team, what's your temperament and how you handle those things. An ability to determine really what matters for a company in the midst of the flood of information out there. So that gets to just judgment and intellect as well. And it gets to what you said, but developing and articulating really a differentiated view in each of your portfolio companies and across your portfolio. And it is important to be able to articulate that to investors in a clear way so that we can really understand. So.
Yeah, and if there too, I can pick out one point. I love your openness in saying, managers in their first, second, maybe even third year, that's just in the too difficult bucket for me. And, that's the message I've given to people, is you shouldn't expect the money to start flowing in from day one. The important thing is to give yourself enough runway to build your firm, to build your reputation, your track record, and then very likely in year 5, 6, or 7, things will work out, but most likely not in the first year. maybe two more questions I'm going to ask. The first one is, which I know is on a lot of your minds, but maybe too embarrassed to ask, so I'll ask it, which is people who would like to attract your attention as potential investors in their fund, should they reach out directly or should they wait organically until you kind of come across them? Maybe start with Thomas this time, if you want.
I mean, we are not well known by design because the family thinks, well, if nobody knows, well, not that many people know us, it's kind of good for their safety. So, so there are not that many managers coming to us, so we have to find them. So it's hard to answer. Obviously, we would have. Sometimes we are kind of jealous on the U.S. endowments because they see everybody. They don't have to. They come to them. We have to find them.
Is that true? Or?
For a $1 billion foundation, no, it's not necessarily true. We're not Yale, yeah. So.
Sorry to interrupt. I just wanted to see.
No, but so for us, I think it's not really the question because we have to find them anyway. So we are Munich-based, so it's not a hub. So
it wouldn't be a massive turnoff if someone were to sort of like reach out to you directly.
It wouldn't be a turnoff, but kind of obviously, if you get a good introduction, that's kind of a better start than. So if you as a young fund manager, you can build from your network and kind of have the first investors starting from a network and get good introductions. I think introductions always help than getting a cold email. And you really have to differentiate yourself if you write an email because we get quite a few.
I can imagine, yeah. Jason, do you want to chime in?
Yeah, I'd love to jump in on this because I have a strong point of view. The answer is yes, please reach out. We've been through this. We have pattern recognition. We can very quickly determine what interests us, from a review of materials, whether or not we want to have a conversation. After a conversation, we can very quickly determine whether we want to move forward or not. So, and again, we're not well known either. I have a small team of 4 people. We really do focus. I mean, I welcome inbound inquiries to me or my team, absolutely. We are. There are many institutions out there that are larger that have a really supreme incoming deal flow. We welcome it.
Okay, I wouldn't want to be the one reading your inbox on Monday morning, but.
Sargent, I can jump in on this too. No, I agree with you, Jason. I think reaching out is always actually one of the worst feelings is when you find someone that's already sort of built their business and we don't know about them. We pride ourselves on not having that happen, and so please do. We have an investment team of 15 to 20 people. There are 2 of us that are here today, and we'll be around. So we do appreciate those inbounds. It takes time. So I think patience is a huge kind of send the email or reach out, and then be prepared it will take some time to get to know us and build that relationship over time. I think one of the things that is really helpful for us, if it is kind of in your DNA and you like to write and you're good at kind of putting your words down on paper and writing letters, that is so helpful for us because it really does differentiate that kind of cold email, because someone on our team will go through that letter and read it, and I think about. Yours is a little unfair. You'd been around for quite a while by the time we met you, but I had read all of your letters by the time we'd sat down with you, and so had my colleague Graham, and so it just made so much of a difference to be able to have that kind of underpinning, and it adds a lot to the kind of the foundation.
If I could just add to that, yeah, when you do reach out, please include materials or letters or anything like that so we can get that first cut and look at it. That's much more helpful than just sort of reaching out and asking for a meeting.
Yeah, and I agree. Like if write down what you aspire and what you want to be and what you want to become, then obviously you get a much bigger chance of getting an honest reply from the allocator as well. Otherwise, it's just like.
I love the answer. I've just derived so much benefit from sharing my letters. And even today, I still see people who are very secretive about their letters. They watermark them and all this kind of stuff. Especially when you're at the very early years, you're trying to draw attention to yourself. I can't emphasize enough how much it is to be transparent about what you do. Okay, one last question for me, and then I'm going to hand it over to the audience. And you might not want to answer this, which is totally fine, but are there any big sort of turn-offs which you would want to draw people's attention to?
I mean, I can think of one. It probably doesn't apply that much to this group because you all seem to be a bit more independent. Some people use kind of third-party marketers or people like that, and you just get hit over and over. So, you know, we have a database, we know who people are, we try to keep track of it. Sending follow-up emails is fine, but, you know, I don't need 10 a year. I think, you know, there's a persistence level, but generally that does come from, you know, more of kind of a marketing arm of a firm, which again may not apply as much here.
I never even thought of that before, but that intrigues me. So you're going to share 50% of your economics with someone who's going to lower your chances of getting an investment. And sounds like maybe not someone I'm going to be investing my money with. Jason?
I might say for the type of manager that might be here for a smaller shop, individual PM with a small team, there's probably less chance of a turnoff when you're outreach. I think it happens more in the larger firms or when you have a placement agent or a marketer that's reaching out to you in a larger firm that maybe hasn't listened to your feedback of I'm not interested in this strategy or that. I think it's probably just less apt in this type of investment manager. That said, being overly aggressive, I think is a turnoff for anybody. But yeah.
Great, thank you, Thomas.
I mean, maybe also accept the no. So, like, if you're not a fit, it's not a fit, and you shouldn't take it personal, but rather try to get honest feedback, because some people will just say, I don't know, we are over allocated to equities currently, which is not true because it's the easiest answer. So, I think if you can get honest feedback, that should help you if it's an investor you really would like to have on your as an LP in your fund. And if he says no, just take it and accept it. And if he gives you a good answer, even accept it even more, because he's not going to change his mind by another 5 emails.
I think I would just say that's important too. Is for people that we do spend time with, or we give a review of materials, we do really try to respond with something that says this is why we're not interested, or it's not a fit for us at this time, or maybe later. But I think that feedback is important, and it's just fair to people.
Yeah, I think it's sorry. Yeah.
This slightly different angle on the same, but I think one thing that from a kind of process approach perspective, we will do kind of day one investments. We will invest early with managers. We don't have a lot of turnover in the portfolio, so we don't have kind of an emerging managers program. We don't have a big book of this, but we will do it. We can be helpful, and we want to be helpful, even in cases where we're not investing. And we can talk about that if we want to in some areas. I think the one place that you're kind of asking about turnoffs, we don't want to tell you how to invest, and so that's something that should be just rock solid. How you evolve and how that manifests itself into a portfolio and what that looks like over time. That can change. We're very open to all of that. But like that core philosophy of how you invest, I think a killer for people is if we sense sort of a should I be doing this or doing this? Like, I don't want to answer that question for you. That's something you really need to feel and own yourself. And everything else we want to be helpful for, and we hope that we can be.
And I agree. Kind of, you have to really know what you want to do before you start, because there will be bumps in the road. And if you come to the investor and say, oh, I'm changing my strategy now because I have that big less. So adjusting and getting better, definitely important. But kind of, I changed my strategy now because of that bump, and I learned such a big lesson. That's tough. So you really find your strategy, find what you want to do, and do it.
Yeah, I love the answers, and in completely different contexts. Obviously, I don't interview investment managers, but obviously, I interview service providers sometimes, and it's emotionally awkward to tell someone you don't want them, you've chosen someone else, implying you think that other person is better. But it's a matter of politeness and character to do it. And occasionally the person I give that feedback to is then really sort of angry with me, takes it personally, and you're like, okay, I did something I didn't want to do, and I'm sort of in a worse place than where I was beforehand. Yeah, I would definitely echo that message. Even if it's a no, you should appreciate the feedback you get from that. Okay, is it okay to hand it over to the audience now? Great, I think we've got about actually even 20 minutes for questions, so far away. I can see Tim at the back there.
Hi, Tim Liu here. My question is, so when I talk to allocators, they often want to see a team of like multiple analysts and PM. And so for me, right now, I'm just by myself, and I probably want to remain that way for the foreseeable future. And so my question is, how much of a turnoff is it to see a single PM or like one-man shop, so to speak? And how much higher does the hurdle go when you see something like that? And then a different question, kind of echoing what Rob was asking the panel earlier, which is how would you advise young managers to break through the chicken and egg problem where you don't have much AUM, and so a new check that comes in, it has a lot of difficulty because it has to be below X% of the fund, and then everyone runs, you run into that with many people, and so how many years of track record, or like what advice would you give to emerging managers for how to break through that? Thank you. Okay,
we'll split it into two, so maybe the one-man shop question first. What do you think about that? Who wants to go first?
Yeah, so I think people have different points of view on this. My main rule is I try not to overgeneralize and have hard and fast rules. I'm totally comfortable with a single PM with no team, and it's fine if you want to, you may want to develop that over time. We've invested with people that are just single PMs that have built a team over time. Some people do have a different point of view. They do want to, back. It's obviously a single PM, but backing a team behind them. So it's not so much of an issue for us.
I mean, we like a bit broader team use usually, so but we really like the single PM as kind of sole decision maker. Kind of you have to be accountable, and you write a lot about it. It has to be your decision. If you go for a bigger team, I think hiring also a COO, kind of taking off all the compliance burden initially, and maybe also doing the first 15-20 minutes of your investor meetings if it's really strong, might help you as well. So if you go for the route bigger team, then really hire a strong second person which you really trust, and we heard this morning, like really, it can really help you, and it's not another kind of burden who wants to be another founding partner of your business. It's you're the founding partner, but you have a strong lieutenant who's helping you on all the administrative burden, can handle some of the investor work, but you should still be kind of the main contact for your investors, I think, in the beginning. Sargent?
Yeah, I think we're also open to lots of different structures, and so we have plenty of groups with large teams and plenty that have small or in some cases really no teams. I think when it's just you, there are maybe two things to be thinking about. One is what is your sort of sanity check? I think for you it's always been your network. But when things are, going well or going poorly, and you need to be pushed a bit, sometimes a team can help you do that. There are other ways to do it as well, obviously. But that's helpful for us to understand. We have this one person that's sitting here. Stocks move a lot. How are they handling that? What's what's kind of the support mechanism there, and what's the sort of the pushback mechanism as well? And so that's something we'll want to understand, even if it is just a one person team. And I think the other piece is understanding your expectation of what this will look like long term. So it may be that this is what you'd like to have it just as just you for the next 40 years, and that's fine. If you did want to scale it, you wanted to bring on a few analysts, like we would want to see that you've thought about that, and what you're trying to accomplish there.
Yeah, maybe just anecdotally before we go on to the second part of Tim's question, any sense of whether investment performance kind of correlates with team size, either positively or negatively, or it's just not a factor at all?
I mean, there's probably, I think that the adage in our world is that a certain level of AUM and certain level of team, and then things start to deteriorate a little bit, and I do think that that's probably true in some cases. What exactly that point is, I don't think 1, 2, or 3 is sort of the number of your team that's starting to like hit you into that spot. It's all very personal, right? So if that's how you work best, then that's what we want to see you doing. But I think you probably have a long runway on that one, in terms of not having to worry about that piece.
Yeah, I don't have it's a great question. I don't have an answer for that. It'd be something good to look at. I mean, there have been individual portfolio managers that have done a great job of adding value over time. But, to your point, I do think it's important to have that check however you get it. But at the same time, the reason that I'm comfortable without a team is because we really are seeking people that have independence of thought and do their own work and, are the primary relationship with the companies in terms, it's great to have an analyst to help you, sift through things and increase your productivity. But at the end of the day, you've got to know everything. And, it's one of the turnoffs is, seeing too much filtering going on between a company and the ultimate portfolio manager.
I mean, for us, it's usually the end of, or kind of, it's a high hurdle to continue to invest when the head of research is hired. Kind of, if you have like the analyst kind of reporting to the head of research and he's filtering to the PM, that's kind of, you have maybe too many people because you're not able to manage your people anymore. So you have a head of research. So if you think of that, you're either not hungry anymore or kind of you're having too many people, I think.
Such a fascinating answer, because I imagine a lot of people think if I don't have like at least one head of research, 6 analysts and stuff, there's no point even bothering reaching out. And actually, you're saying it's the opposite. So I love that response. And then the second part of Tim's question was like the sort of chicken and egg dilemma, that the perception I think of many young investment managers is like, without a track record, you're not going to attract the capital, but without capital, how are you going to start building a track record? So, I know that's not your problem, but any thoughts you might have on that would be interesting.
I mean, I'll start, but it's not a very original answer because it's basically repeating your letter. I mean, I think that the ability to kind of be self-sustaining and focus on returns. We all pride ourselves on being independent thinkers and not following the herd, and we do that sometimes. And so, you'll get no for 3 years, and then you'll have 700 people that want to invest on in the 4th year. And so, if you're performing well, and so I think, head down, generate performance. If you write letters, send those around. I think events like this are great to network. To your point, actually knowing someone when the email comes in and having met them makes a big difference. And just be patient. It takes time. In many cases for us, it will take us a couple years before we invest. Not always. That's not any sort of mandate, but it does work like that way sometimes. So I think just focus on the things you can control and try not to build an organization that forces you to do something you don't want to do on the LP side.
I mean, it's hard. Don't want to be in your shoes, no, but I think it's really kind of lining out what you want to do and convince investors by what you have done and what you're gonna do, and show you're going back to showing what's your organigram in 5 years, so how many analysts you want to have, and kind of really showing the trajectory should help, and then it's. Like also we heard this morning, it's a bit of luck as well, I think, to be honest. You get the first good investor, big investor, he knows a few people, introduces you, they introduce you to a few, so I think that's unfortunately, the luck is also involved.
Yeah, I mean, I'd echo some of the same things. It is a difficult challenge. There's a far smaller sort of group of allocators that are willing to take, some risk. There's some business risk in that. But I think I'd go back to the comment, and I think here is just that ruthless focus on just outperforming in your portfolio and building that track record over time. You can do it on a small asset base. At the same time, having your thoughts out there, writing, so that really when you look back and you have outperformed, you can really articulate that to people that you engage. We want to be able to see, not that there's just outperformance, but how is it generated? Is it consistent with the materials that we looked at 3 years ago that you laid out? If it's different, and that's fine, why? But really a clear articulation of like how have we added value too.
Great. Who'd like to ask the next question?
Hello, gentlemen. Thank you very much for being part of this conference. And I'm going to take a little bit of advantage of you guys being there, invert this. You're usually asking us the questions. Go into your...
Revenge is a dish best served cold.
No, but I'm sure you would agree that track record is a big part of what we do and how you sort of evaluate people. And so to that effect, it would be very interesting to know how many, let's say in the past 5 years, how many managers you have invested with. what the sort of initial allocation would look like. It obviously can be a rough estimate, 6, 7, 8 figures, and how you test them, whether you have some sort of lookup and you're like, okay, so I'll invest with you and it'll take 3 years before I actually evaluate you on a performance basis or not.
So on the public side, we do like 1 to 2 every year, and that's the same for the private equity side. So in addition to the re-ups, so it's like maybe we do 4 managers if it's a high velocity year or a high turnover year. So hopefully pretty stable, which helps once you're in the portfolio, obviously. And now I'm blanking on the second part. The time, sorry, and then kind of. So I think like returning the capital to the manager after 3 years is kind of a big, has been a kind of a due diligence mistake, because so we want to be really long term. Obviously, we give the manager 3 years, and we have to understand what's kind of why they performed the way in the 3 years. And we are obviously, if you're invested, we're much closer. But it should be a partnership for 10, 15, 20 years, ideally. So 3 years is always a big disappointment, and we do it maybe once every 5 years, maybe, that we turn back capital that early.
Is it fair to say that would be less driven by performance and maybe more due to other things happening?
Yeah. So after 3 years, you don't know. So if you redeem due to performance, it's always kind of had been a mistake, because you should redeem basically if the manager outperforms and you believe that's now he's at the peak now. Yeah, there has to be other things that we believe he's team turnover, or he's maybe if it's a young manager we think, well, maybe he's not like a great business builder or anything like that.
Yeah, I think there's a little bit of a balance here, right? So if you are doing 1 or 2 new things a year and you want to hold those things for 10 years, you actually don't leave a lot of room for emerging manager checks, right? Those are things you're going to want to be, pretty certain on. And so we've tried to give ourselves a little bit more latitude on, that would be sort of the general, pace for us. We would do within the public equity strategy, maybe 2, 3 new things a year. If it's someone that's on the younger end, and the most recent one we did there was probably 2 years ago, we may start a little bit smaller. We may think about 3 years as a period where I agree with you. In most cases, if you're redeeming after 3 years, you've made a mistake. Something's gone wrong, and it's not generally for performance. But for newer managers, we might do smaller checks, a few more of those, and then have this kind of 3 to 5 year sort of up or out, right? Like it's a little bit more of a test case. And so we've tried to take that approach, because otherwise you just get yourself in this box where you almost just exclude emerging managers altogether, because the bar is just so high and you don't want to be coming out after 3 years. So we'll do a little bit of that on the emerging side.
Great.
Hi. I'm someone that sits somewhere between the emerging managers and what Rob does, so I've had a bit of experience of meeting different sort of allocators. So one, I'd echo what Tim said at the back, in terms of you get quite conflicting feedback about you've not got a big enough team, you've got too big a team, you've not got enough people in compliance, that sort of stuff. So it's really interesting getting your feedback on that bit, because it's never the same. It'd be really interesting to get the same discussion on structure and regulation. So I'm FCA regulated, I run a UCITS fund, but then you might go and meet someone else that says, well, we need you to have an offshore fund, or you're not SEC registered, or whatever else. So how important is it from your end that the person's already got the right structure? Or would you just like to speak to people who are good managers, and then you'll worry about the structure somewhere down the line? Because that's the other thing that comes, is you get a bounce back depending on your current structure or your current regulation.
Is it okay if I respond to that one?
I'd love to get your view too.
So I feel quite passionate about this. I don't think any structure should be based on what you think somebody else wants. That the structure should really be based on what do you need to put in place to beat the market. And then if you do that, things will come later. Now, obviously, from a legal perspective, if it's a certain type of fund, not everyone can invest in that. So that's a consideration later down the line. But the first and foremost, you shouldn't be canvassing an opinion on how many team members you should have or that kind of stuff. It should be based on what you think you need to be successful. But I'll let you guys respond as well. Sorry, I just had to jump in there.
I mean, maybe on structure as well, like UCITS is kind of, we really don't really get it, kind of why UCITS. We have to do our diligence. We don't need to be protected by the regulator, we believe, or otherwise we missed our job. So it reduces your discretion and your freedom, so it's rather the investors who want to go out more quickly, so you might attract the wrong investor base. So it's rather like a negative selection on the UCITS side maybe for us, because we think maybe wrong investor base, not that long term. We have to take care of the asset liability match in your portfolio. But except for that, it's the second step, looking at the structure. Jason?
I would say we don't really run into this issue that much. I mean, we've got to have a legal structure in which we can invest. It's important to us. But I'd be we haven't invested in a UCITS fund and probably wouldn't. I mean, I'm not as deeply familiar with that structure. But we generally just haven't had an issue. The people that are approaching us, we can find, they either have a structure set up or we can find something if it's something we want to do.
You agree?
Not much to add on that.
Who wants to ask the next question? Claudine?
Hi, thanks. I had a couple of questions on how you judge a good process or a good philosophy. So how much transparency do you like to see or want in terms of what's in the portfolio, the changes that have taken place, and what's driving returns? So over time. So I often wonder whether institutions would have invested with Warren Buffett with the kind of information he gave at the beginning in his partnerships, which is very little apparently. And the other question is related is the power law. What happens if you have a fund that's very concentrated and they make the money in 2 stocks and 8 stocks are doing nothing? I mean, do you want to see that most of their decisions are good, or are you happy? No, they just make the returns. It doesn't matter. So I guess a way of judging risk of the returns.
Yeah, I'll start there because we think a lot about this and it's really important to us. So the more data that we can see, and we're very confidential about it and happy to sign anything, but the more data we can see, the better. A manager can tell us anything. We can look at straight line performance versus a benchmark. That really doesn't give you any insights at all. So we need to go much deeper. I think it's something that, one, there's more tools out there. We've gotten a lot better at it. I've evolved in my career. It's one of the learnings that I've had. And we do have the tools to look at. We'd like to have, quarterly holdings at least to be able to look at your track record and find out where the value is coming from and what deviations you're taking from the index. The power law question is a good one because I have analyzed managers. And you do have to go deep to do this. It's not something I necessarily did earlier in my career. You could get at it sort of qualitatively. Again, I try not to make hard and fast rules or generalizations. So we have invested in those managers. We identify it as a risk in terms of like, hey, a lot of the value here has been created by 1 or 2 companies that they've invested with. There might be, a bunch of others that have not done so well. So as long as we have knowledge going into that and, we make an informed judgment on whether or not we want to invest, I'm a little bit less concerned. I mean, it'd be great to have, positions contributing across the board, but sometimes it's just not like that. So it's really sort of we want to have the quantitative information and then ultimately we'll make that qualitative judgment.
Yeah, I think it also depends a bit on the strategy. So in broader portfolios, so in a long-short portfolio that may have more names than the long side and short side, certainly in things that we would do in like an absolute return space, you do want to see that hit rate. I think this world is a little bit different of concentrated public equity. I would just agree with Jason. If we just need to know that. In some cases, maybe we need to think about it almost more like a co-investment and then we just need to size it appropriately. So if that thing runs 200%, we should probably be just trimming it a bit, right? Or maybe not, but we should be thinking about that at least, right? And so we're comfortable with it, but obviously, all things equal, you'd like to see a few more wins than just one.
I mean, I agree. If the manager is in the portfolio, it's it's okay if you have two outperformers and they make a lot of the outperformance. If you do due diligence, I think the more outperformers you have and the broader it is, the easier is it for us, at least on paper, to kind of have luck and skill, and understanding what's luck and what's skill. So if you have like one hit, it's kind of, well, was it luck or was it skill? And on the transparency side, I think, yeah, the more the better is always kind of the obvious answer from investors, I think. And for us, it's really, I think it also helps you to understand what's going on in the portfolio. You can kind of track the performance also intra-month and kind of you're not negatively surprised at the end of the month. So we don't care about monthly returns, but just like, you know what's going on, you know what's in the portfolio. You can follow the companies, you can have more educated questions, hopefully, with the managers, and that helps a lot. And we hope, being that close, that we should know the portfolio anyway. And they're all long-term investors, so there shouldn't be that much churn that it makes a big difference if you send us the names on a quarterly, maybe a quarterly lagged basis, but can get a feeling of the portfolio.
Just on that point, I think, yes, more is better. I think a little nuance on our end on that. A lot of our initial meetings with managers, we're spending time trying to understand them. And you asked, I think, the motivation question earlier. I think that's a really important piece, and that's something we're trying to get out of those meetings. When it comes to kind of process, approach, investment style, we really try to get at that through largely through discussions around portfolio companies in the portfolio. And so that transparency is super helpful in those initial meetings. If someone were to send us 10 years of monthly returns and all the we've never met, we're not going to probably do very much with that. So what we typically do is we'll do that first meeting. We may sit down afterwards and kind of put our heads together. Is this worth a little bit more work? And then we may reach out and ask for some of that more detailed information. But we would certainly want it earlier in the process.
And I agree. It's not like send us whatever you have. It's just we find something in our due diligence and we want to know more about it, and then we ask you for detailed information. And if the manager says, "Oh, I'm not sending it to you," that's kind of more an issue than saying we're not sending you all information we have.
Claudine, did we hit on both parts of your question there? Great. We're slightly after midday, so if there is one last question, happy to take it. If not, we might start
we could have
wrapping
a quick one from the internet, Rob.
Yeah, sure. Where are you?
To your left.
Here we go.
Sorry.
Nick.
Just quick question on cash levels. Those that don't, you view on fully invested or holding some cash, and those that hold cash, how do you judge how they handle that during different market environments, dislocations, et cetera? If you have a view, you may not have.
Yeah, no, I think that also sort of falls into the personal style bucket. It is in a world where equity markets generally go up. If you hold 30% cash all the time, that's on you. We need performance, and so but if that's what makes you feel comfortable, we do have managers that do that. Maybe not quite that high, but we do have managers that will hold cash. I think the one that we would be watching for even more closely is if you've presented yourself as a bottom-up fundamental investor in 8 to 10 companies, and then we see you moving your cash levels around because of macro situations in the world, that's a hard game. It's not so that's something we really want to kind of understand if those things are really swinging around for sort of at least bottom-up fundamental reasons.
I agree, no macro views, not saying, oh, markets will go down, we're going to have 30% cash. But if you say, well, we don't find any ideas, it's just hard currently, then it's okay. And we also learned if the manager knows what he does, and he did it for 10 years, and he has the 20%, and it makes him take more risk on the 80%, and overall, and he should invest all his money, and kind of overall it gets to better performance. We shouldn't make him go to 100%. I think that's also some mistakes we also made, like pushing managers to things that's not in their DNA. So it has to be in your DNA. You don't make a benchmark hugger to a high conviction manager, and you're not making a person who loves to have 10, 20% cash to a 100% invested manager.
Yeah, I mean, I'd add a little bit to that. I think one of the good things about cash levels is that, with a track record, you can look at how much it's detracted or added over time. And that is something that we would look at. I think my philosophy has changed a little bit on this too, market performance is not something you control. We all keep reserves in our portfolio. We all want to be able to invest when prices fall a little bit, but it makes me, I'm much less apt, in fact, wouldn't do it now. If a manager tends to, raise cash levels to 20 or 25% in anticipation of markets falling, that would make me a bit uncomfortable. I just really want you focused on the companies that are in your portfolio.
Sorry.
I wanted to answer a question from earlier, if I could.
Yeah, please.
Not at the risk of holding everyone up from skiing. There was a question actually in one of the earlier sessions about, kind of these meetings that you do with people like us, kind of forcing you into, into a box a bit. And I think, when I reflect on some of our best investments and the best investors that we've spent time with, creativity is a really big piece of what has made them successful, I think, whether that's in the ideas that they find or the way they do research. And that sometimes can be kind of hard to get into a PowerPoint presentation and hard for people to understand what you're doing, but just don't let us squash the creativity, because if you can generate great returns with it and it's a real piece of who you are, I think it's really important on the other end.
Awesome. Well, we're a little bit after midday now. I promised we'd overrun a little bit, but I know it's a wonderful day out there and you all want to get out there. So all that remains for me to do is to thank my 3 panelists from today. And of course, Nir and everyone else who's appeared on stage here, and of course you, the guests, for coming along and making it the special event it is. So thank you to all of you, and I look forward to seeing as many of you as possible here in 1 year's time. Awesome, yeah.